Hello, everyone. Welcome back to another update on many different macroeconomic events and fundamental events in the equity market that I would love to get to addressing here. So we got a lot to cover here, so let's get started. So just sit back, relax, grab a bite to eat or a cup of coffee, and hope you enjoy this presentation update. So, as I've been talking about for the last several weeks, months, almost, about 6 months now, I've been, very cautious on the equity market for a number of reasons. And the last several updates that I've made here, I've used the same exact title. Stocks are defying the Fed and economic data. My question, again, is today, as it has been for the last several months now, will it hold? So let's check out exactly what I have been seeing here overall. So here's just a quick rundown of recent events. The Fed has now taken us to 5.25% on the federal funds rate, and they also signaled a pause and evaluate going forward. So this is the highest we've been since 2007. So it looks like they're going to be done here for a bit. But they're basically going to evaluate. Or initially, and I have some comments and thoughts on this. Initially, when this came out, the market liked it because of the pause and evaluate sort of language, and it looked like they were, going to be just about done. I'm starting to have second thoughts about that. I still think that they are done, but it used to be a sort of a 99% certainty that they're going to be done now. Now that number in my mind has moved down to about 80% that they're going to be done. But, the chances of them increasing rates a little bit more just went up just in the past month or so. And, the reason for that being the AI bubble, point number 3. We've seen, a dramatic move in AI-related stocks. And the reason why I think it's a bubble is because a lot of companies that are just simply working on this but aren't anywhere close to commercializing it or, let alone generating profit from it, are still experiencing, massive rises in their stock prices. And this is basically reminiscent of 2021 all over again. We'll just take a quick look at a chart on that. With regards to earnings, Q1 is now in the books, and earnings were not as bad as expected. So they did beat by a pretty broad margin. So both revenue and earnings were beat. The beat rate has been tracking above the 4-quarter average. And so that means that earnings weren't as bad as feared. However, that just simply means that expectations got very low, and actuals weren't as bad as the expectations were. But if you look at it from an objective point of view, the growth continues to wane. So you'll see that the growth has steadily, decreased in terms of the rate of change. And we'll see a few charts on that. U.S. manufacturing is very clearly in recession. We have multiple indexes confirming each other. We'll see a few charts on that, but that sector is very clearly in recession. Meanwhile, depositors continue to pull billions out of commercial banks each month. That number, just has not stopped. As, interest rates have risen, most commercial banks still don't pay much of an interest rate on deposits because they can't. As we've seen with these dramatic unwinds of banks like Signature Bank and Silicon Valley Bank and PacWest as well. These banks are simply unable to pay interest because they have an asset liability mismatch, where they bought, a huge amount of treasuries at near zero interest rates, thinking that rates will never rise again. And here we are, rates have doubled from the point that they bought them in terms of the 10-year treasury yield. And so they're sitting on huge unrealized losses. Now, those losses will reverse themselves, but the problem is that if depositors pull money out, then they need to figure out how to meet those deposits. And, we've seen that certain banks were unable to do that, and that's why they have wound down. Other banks could be vulnerable, bigger banks that would have a real impact if they were to shut down. So the mess here, I don't think has ended. In terms of these banks unable to meet or keep up with the rate of withdrawals, I should say. So all these events are a major negative for credit creation. I don't see a reason why banks should be expanding credit at this juncture when they are not able to meet the rate of withdrawals, as well as when manufacturing is in recession. So this is a very major negative for credit creation. That's sort of an underpinning of economic growth. So when this starts to fall, I would expect GDP to slow down quite a bit. Now, I personally feel this is just an opinion, but I believe personally that the Fed has gone too far in rate hikes because inflation is already coming down, and further increases only inverts the yield curve even more, which puts stress on the system. So I think that the pace of depositor withdrawals might only accelerate in coming weeks and months as 5% interest rates entice millions of savers to pull money out of checking accounts into money market funds. And that's exactly what we've seen. So in terms of the AI fever, you can see here a chart of several quote unquote AI companies. These are just a year-to-date chart. You can see the ticker AI, which does not have any earnings that are backing this, but the stock has tripled year-to-date almost. Nvidia, we've seen that basically shocked the world. Nvidia is up 158%. These are not small cap names, right? These are massive companies that have multiplied that have more than doubled year-to-date. Palantir is another one that a lot of people like and talk about. That one's up more than double. Cloudflare, Broadcom, Google, Microsoft. The worst performing of this group is Microsoft, and it's only up 37% year to date. So these are, mega caps. These are just incredible, sized companies, all up, 30 to 150% year to date. Now, not to say that any of these are bad companies, just saying that, this is a bubble sort of activity when stocks go vertical. Now, Nvidia, however, is interesting because they came out and shocked the world when they reported their first quarter numbers. They, came out and just shocked everyone by guiding for $11 billion in next quarter revenue, when the street was expecting just $7 billion. That is a massive shock, and that too a near-term shock, because this is just next quarter. So whatever this AI story is here, it's translating to real revenue and earnings growth for NVIDIA. So that's why NVIDIA's move has been so sharp that it's been sort of, the leader of the pack, and many other stocks are kind of riding in their tailwinds here. But you can start to see now, ever since that they reported earnings, analysts have started to mark up earnings expectations for this year and next year. And that's a pretty sizable move up from $5.98 for next year to $6.50 for next year. That's a pretty big move. And so NVIDIA trades at roughly, 70 PE now, a forward PE of 70. That's pretty high. I think it's fairly valued here. But, the question remains is how sticky are these orders that they're seeing for their next generation GPUs that are sort of the cornerstone of powering the computing necessary for all of these AI applications. It remains to be seen whether this is a passing fad. Now, this may be real. It's definitely real earnings, real revenue. But the question is are these AI applications like Midjourney, which, generates, uses AI to generate images, or all these other sort of, deep fake type, systems where you can create video is is this a passing fad, or is it, does it have staying power? Meaning, are these applications building the future, or is it just, a passing fad for entertainment purposes? That remains to be seen. But for now, these are real revenue and real earnings that are passing into NVIDIA and other companies as well. TSMC is another beneficiary of this because they are the ones that manufacture these chips. So whether this has staying power remains to be seen. But in terms of the earnings impact, this is a very real earnings impact that we see here. So that's sending earnings higher. Here you can see Q1, the beat rate in terms of companies that reported earnings. 77.6% of all S&P 500 companies beat their Q1 expectations on earnings. 74% beat on revenue. That tracks, above the past 4 quarters. And it tracks above the 5-year average here at 69.3. Same thing with earnings here. It's slightly below the 5-year average, but definitely above the last several quarters here. So earnings were better than feared. However, growth rates continue to wane. Here you can see the earnings growth rates year over year by quarter. You can see that it peaked in terms of the comps here at 38% year over year growth in earnings. That was a very low sort of benchmark because of the prior year was COVID. But now that we've cycled out of that crazy COVID depression and then post-COVID high, now we're starting to cycle out of that, volatility here. And we can start to see that, these numbers are coming down. The growth rates year over year are coming down now that the sort of the comparisons are more, apples to apples. Same thing with revenue growth. You can see that, the great recovery post-COVID has now sort of worn off, and you can see that the rate of change of revenue growth for the S&P 500 has been, coming down. And I believe this is going to continue to come down. You can still see that, despite NVIDIA and despite these AI stocks rallying, you can see that the S&P 500 average on the aggregate are coming down. Now, we did see a brief hiatus after Q1 earnings were reported, but you can see that estimates are now once again coming down here. And we've matched the lows in this cycle here, $5.67. This is a bottom-up weighted average of the S&P 500. And so now it's matched the lows here. The rate of change has slowed down for the past couple of months. But now let's see what happens as we enter Q2. I believe that this number is now going to continue its slide down. So despite the fact that stocks are up, earnings estimate revisions are not up. In fact, I believe they're about to get ready to start to come down again. And it remains to be seen, but I think that this low will be taken out here in the not too distant future. Same thing with next year's earnings. You can see that we had a brief respite here where we hit a low of $6.31 for fiscal year 2024. That has stabilized and started to, move up a bit after Q1 earnings were reported, and they didn't come out as bad as feared. But now we're starting to see that number come down again, $6.31 on a bottom-up weighted average basis. I think, again, these numbers are going to start to come down even more. And why is that? It's because U.S. manufacturing is already at recessionary levels. And keep in mind, these indicators, Chicago PMI, Philly Fed Manufacturing Index, ISM Manufacturing PMI, these manufacturing gauges, both regional and national, share a very high correlation to S&P earnings. You can see here that just yesterday we got an update here. Chicago PMI has been in a deep contraction now for months. For more than 7 months now, we've been declining on Chicago PMI, which measures the manufacturing activity of factories located in the Rust Belt of the U.S. So basically the Midwest of the U.S. That is sort of the heart and soul of U.S. manufacturing. And that number has come down significantly. We had a little bit of a rebound here. It bounced back to 48. Remember, anything below 50 means that we're in contraction. It did rebound to 48, which is still contraction, but not as bad as where we got. But then just yesterday, we got an update, and that was at 40 once again. So it looks like we're going to double dip here back to the 30 level, back under the 40 level. This is a very, very clear indication of recession. Last time, anytime Chicago PMI gets that low, it has been a surefire bet that that would be a recession oncoming. And that's where we're at right now, at a 40 right now. Same thing with the Philadelphia Fed Manufacturing Index. This is also at recession levels. Look at this. I just highlighted here in red. Anytime we've been below negative 25, that has correctly forecasted each of the last 8 recessions with no false positives. No false positives. Every time we've gotten this low, and we did get here, it has bounced back to minus 10, but it doesn't matter about, the bounce back. What it matters is getting to that level. Every time we've gotten to that level, we have bounced back, but simply reaching that level has been a early warning sign of a oncoming recession. And we got there just last month. Now it did bounce back. Let's see where we go here, but it did get to below negative 25, in the April month of this year. So again, this is an indicator that has had a 100% track record dating back to the 1970s. It has correctly called the last 8 recessions. So I don't think this one will be any different. So we'll see what happens there. ISM manufacturing PMI, similarly in recession territory. We're below 50 here. This is basically the lowest it's been during every recession it's gotten this low. Now it was much worse in COVID. It was much worse in the great financial crisis. It was also much worse during the dot-com bust in 2000. But this is nothing to be proud of either. So this is, again, another indicator. This is a national index that is once again in contraction mode. And again, history has shown that whenever the Fed gets this tight, this is the Fed funds rate minus the 2-year yield. And this number is, again, deeply inverted. This is a very short-term indicator, a short-term interest rate benchmark, the 2-year yield versus the Fed funds rate. Anytime, again, this has gotten this deeply negative, inverted, below zero, that has once again been an indication of a oncoming recession. And that's where we're at today here. Deposits, again, look at this here. This number just continues to march lower. This is very, very bearish for credit creation because remember, banks depend on this. And if banks are being forced to find ways to meet these withdrawal requests, then that's simply going to come out of the budget for credit creation. And again, if delinquencies are rising, which they are, if bad loan loss provisions are rising, then this is basically a perfect storm for credit creation coming to a screeching halt, or at least very, very slow. This is very bearish for auto loans. This is very bearish for mortgages. This is very bearish for business loans. It's very bearish for all loans overall. So again, I don't see a lot of reason to be bullish on the U.S. economy. Inflation remains high, but you can see that the rate of change is down. As I've been talking about for since September of last year, you can see that the backlog index, the ISM manufacturing backlog index, shares a very high correlation. This remains in deep contraction here. That means that production is outpacing new orders. So production capacity has outpaced new orders by quite a significant margin. This is very bearish for inflation. And this has telegraphed this move down, for 6 to 8 months in advance. This is why I was very confused by why the Fed thinks that, further rate hikes are warranted to the point where, the yield curve gets so deeply inverted, consistent with recession, when already we see tailwinds for getting inflation down. And again, inflation is a function of production relative to demand. And when production catches up to demand, or when demand catches down to production, that puts, quite a tremendous pressure on inflation. And that's exactly what we've seen. And I see no reason for this number to continue the fall down. As long as this number remains in contraction, which it has, this is going to continue to come down. So I still stick by my earlier forecast that I think we'll see CPI below 2% sometime this year, possibly even negative CPI year over year by the end of this year. I still believe that based on the data that we're seeing here. And as we've seen in the past, these key commodities have basically returned to normal levels. You can see this is crude oil futures. This is probably the most important measure of inflation. This is back down to levels that are consistent over the past 25 years. So there's really just no evidence that we have inflation. Same with wheat futures. That's back down to normal levels. Lumber, which caught headlines, this is back down to 30-year levels here. Again, really nothing to see here. Natural gas, very cheap at this point. So what's keeping inflation up, again, are housing prices, rents, and used cars, and electricity prices. They remain high. That's what's keeping the CPI elevated, but everything else is down. So the problem is that the Fed funds rate is a one-size-fits-all hammer that crushes everything together, but at tremendous collateral damage. So by keeping the yield curve deeply inverted, I think the Fed is making a mistake, because they think that just because certain things are up, they want to crush everything together to get everything down together. But, the Fed funds rate is not a surgical tool. It is a very large hammer. So you're trying to use a massive hammer to tamp down a single tiny nail, when in reality you start to damage other things alongside it. So unfortunately, I think this is a flawed perspective. You have many parts of the economy, like we just saw here, experiencing disinflation. Very important parts of the economy too, not just side, commodities. These are gas prices, wheat prices. This is food prices here. Lumber prices, which goes into so much construction. Natural gas, which heats our homes. These are everyday commodities that we consume. These are all back down to normal levels. So I think the Fed doesn't really need to do much more, but they have chosen to invert the yield curve and induce recession. Other reasons why we should be cautious is, remember, the Fed is committed to removing liquidity. We have seen the biggest plunge year over year in M2 in recorded history. This has never happened before in the 70 years that we've been tracking M2. We've never went negative, and here we are now at negative 4.7% year over year. And that's simply because the Fed wants to return this back to trend, right? We saw this, post-COVID boom in liquidity, and now the Fed is simply trying to reverse the extraordinary monetary policy response that they did. So all the Fed is doing here is getting this back to trend. They want to basically revert this back to trend here. So my guess is they want to get this back to about 16.47, 16.5 trillion in M2. So we've got quite a ways to go here before that happens. Housing prices are beginning to crack here. Median home sales price of new homes are actually down 8%. So again, these are all headwinds for the reason why I'm presenting all this here is that inflation is down, manufacturing is in recession, and housing prices are down. And the reason why this is important is because these are all parts that contribute to the wealth effect. When housing goes down, so does the wealth effect. And when the wealth effect comes down, that starts to weigh on consumer spending. That starts to affect S&P earnings. And again, this is all while unemployment is still very low, right? Unemployment is still at historic lows, but we are starting to see job losses increase. This is the permanent job losses indicator that is reported by the BLS. This, has started to move up. And I have a sort of a 30-week moving average or 30-month moving average overlaid on top of this. And you can see here that every time that this number has crossed above the 30-month moving average, that's been a very strong warning sign of recession. So we haven't gotten there yet. But remember, the moving average this time around is being sort of skewed upwards because of the extreme move during the COVID time. So because that was an unnatural recession, due to a natural disaster, that wasn't a true recession by natural forces here. So I believe that, we are already crossing above what would be the 30-month moving average if we were to go off of 2019 levels. And you can see that that number has almost started to cross here. So we're getting very, very close to a crossover. This is a number that I would keep a very close watch on because till now, the labor market has been very tight. But this is a trend that needs to be kept a very close eye on. This total number of permanent job losses and how this number starts to move. But I believe that the trend is up. It's still very low overall, no doubt. But it looks like we have reached a trough here. And this number is starting to move up. So it's still very early, and I'm going to keep you updated on this every time we do these webinars here. But the moment that this crosses above 2019 levels, I would say right around 1.6 million. The moment it crosses above that 1.6, 1.7 million, I think it's time to get very, very cautious. And I believe it's already time to get cautious now. Because again, what does all this imply for stocks? Here I have a little bit of, sort of chart analysis. Interestingly enough, the S&P has had great difficulty at this level here. So we're at sort of an impasse at about 42.15 is sort of the area. And it's really a range between 4,200 and 4,230, I would say. The market has really experienced sort of a brick wall at this level, but it has been experiencing higher highs and higher lows, or higher lows, I should say. So this is what they call an ascending triangle in technical analysis terms. This is a bullish chart. I'm not going to lie. Everything I've presented to you is bearish, but the price action remains bullish. You can see that this is a ascending triangle, which means that eventually this breaks to the upside. Chances are that it will break to the upside. That's just by probabilities. It's not 100% probability, but it's a relatively high probability that it does. So the price action to me is bullish. Also, it is above the 200-day moving average. That's also bullish. A lot of people like to look at that as the indication of whether we are in a bullish or bearish trend. It did catch that 200-day moving average, back here in April, and it has remained above that now for almost, 2 full months. So again, that is a bullish sign. So despite all of this bearish economic data and bearish earnings, the market wants to go higher. So again, the trend is your friend. You cannot ignore the price charts. I think we all have to have a little bit of humility in admitting that, despite all of our analysis here, we could be wrong. The market could be looking at something else, or it could be looking beyond the medium term here. And remember, markets do move in advance of economic data turning. So that could be the case here. So this is a bullish trend, an ascending triangle with the market above the 200-day moving average. I'm not saying to be short here. I'm not saying to stay out of the market. I'm just saying to be cautious. So if this trend line were to break to the downside, I would get very defensive. So if this drops below sort of the March lows here, and it breaks this ascending, trend, I would be very, very cautious, because that means that everything that I'm telling you prior to this chart here is coming to pass. Because keep in mind, the market is very expensive. It is relatively expensive. We're at almost 19 times forward earnings. The last time, we were at a 5% interest rate environment, the market was trading at a 15 multiple. So you can go back to 2006. The market was at 15 times forward PE. We're at, 18, 19 times now. And that too on lower earnings growth. So the last time we were at a 5% interest rate environment and a 15 PE, the S&P was growing earnings at about 6%. As you can see right here, 6 to 7% earnings growth. We're at negative 3.6% on a forward basis. This is a forward earnings growth year over year. So we're a lot more expensive on lower earnings growth given, the same interest rate environment that we're in. So to me, this doesn't make a lot of sense, why we should continue to go up. And here I included a screenshot of our discounted earnings model. This is available in the Zacks research system software. And if you were to assume, trend earnings growth, which is basically the earnings that the S&P has sustained for the past 25 years, that's been roughly 6.4%. So if we were to use trend earnings growth over the past 25 years at 6.4%, the S&P is overvalued here by over 17% here. So again, from a discounted earnings standpoint, we would need to see much better earnings growth than 6.4% for us to be, justified trading at these levels here, given these interest rates that we're at. So I would be, again, very cautious because, again, we're not at 6.4%. We're at 3.6% right now. This is assuming long-term earnings growth. So we would need to see an average of 6.4% just to justify where we're at today. Better than 6.4%, I should say. Now, right now, the market is expecting, or at least analysts are expecting, a quite a strong rebound next year at 11% earnings growth and 10% thereafter. But again, because these manufacturing gauges are in recession, the longer they remain there, I don't see a reason for these numbers to hold up. I just don't, unfortunately. So going back to this earnings revision trend here, I think that this number is going to continue to come down. We see that that estimates have started to come back down again. As long as these manufacturing indexes remain in recession, and the longer it hangs out here below 50, I believe that these numbers are going to catch down to those manufacturing gauges because you simply can't ignore manufacturing. S&P earnings growth on the aggregate correlates quite highly with Chicago PMI, with the Philly Fed, and with ISM manufacturing. So the longer this remains, I believe that these estimates will come down. So I still think that next year's earnings are overstated. What would change my mind on that? A rebound of these numbers. We would need to see, Philly Fed come back above 0. We would need to see the Chicago PMI come back above 50. We would need to see, ISM manufacturing come back above 50. That would tell me that manufacturing is now rebounding. It has stabilized and we have reached a trough here, and now we can look towards the future. And by the way, these are not lagging indicators. Some would say, well, by the time it comes back, you're already going to have missed the move up. Not true, because these are leading indicators. The Chicago PMI leads S&P earnings by about 6 months. And remember, the market leads earnings by about 6 months to a year. So that means that the Chicago PMI and these other manufacturing indexes is a coincident indicator with the equity market. That's what I would say. So because they both lead earnings, that means that Chicago PMI, ISM manufacturing, Philly Fed, these are all coincident indicators with the equity market. And you can actually see that. I don't have a chart of that, but we can actually prove that out by looking at an overlay of ISM manufacturing with the S&P 500 index pricing. And that's been the case for quite a while. So that's why I say that I believe that these numbers are going to continue to come down. And that's why I still think that the market is overvalued by quite a dramatic margin, by over 17%. I would say closer to 20%. And here I was talking about Shiller PE last, 2 weeks ago. The Shiller PE suggests that, forward 5-year returns may be lackluster. I wouldn't be surprised if from today's prices we see, low to mid single digit returns with a pretty large drawdown in between over the next 5 years, given where we're at on Shiller PE. We can go back over here. The last time we were at a 26 Shiller PE, S&P forward returns for the next 5 years were very, very lackluster. So again, primary takeaways here are manufacturing are in recession. We have a deep yield curve inversion, early signs of steepening, but this is again a recession warning. Leading economic index published by the Conference Board, that's still in deep recession, and it's been that way now for 8 months, and continues to be that way. S&P revenue and earnings growth trajectory continues to wane into negative trend growth. Again, ISM backlog indicates that the CPI will continue to come down lower. Key commodities are already back within normal ranges. There's just no really reason to be concerned about inflation anymore. The bigger concern is recession. And the Fed is hiking and remains aggressively tight into a slowing economy. Banks are coming under pressure. The full extent of the collateral damage is unknown. Estimate revisions continue to trend negative. We still trade at a high PE. So again, even if all of this was true, if the S&P was already pricing in a recession at roughly a 15 PE or even 16 PE, I would be like, well, all of this is already priced in, but it's not. Right now, we're at almost a 19 forward PE. That's highly elevated. So that tells me that the market doesn't believe any of this is coming true. So the takeaway here is I would still remain defensively positioned. I know I'm kind of going against the trend here. The market seems to be wanting to go up, but I would still remain defensive. I would be in 3-month to 1-year treasuries. They offer a tremendous value right now at over a 5% yield with very little to no risk. And I would be in the Zacks earnings certain proxy of high quality recession-resistant companies that are trading at reasonable multiples. So I continue to expect very large downside to the market. I think a $210 of earnings times a 15 multiple takes us to about $31.50. That's over a 22% drawdown from today's levels. And that's, by the way, consistent with what we see in this discounted earnings model here. I'm calling for a 22% drawdown. This is calling for a 17% drawdown. So again, the takeaway here is that the market, I believe, and I know I'm kind of a lone voice here, but I still believe that the market is quite substantially overvalued from today's levels. So the only way I would revise this expectation and admit that I was wrong is if we see a reacceleration in S&P earnings growth, which is led by Chicago PMI, ISM manufacturing, and the Philly Fed index, and others too, like the New York Fed, the Empire State Index, basically all manufacturing gauges. I would need to see those rebound back into expansion territory for me to admit that I was wrong and to be bullish again in the market. But so far, we haven't seen that. So the best capital allocation, I believe, this is just a reiteration here. I continue to believe that the 1-year Treasury which currently pays 5.25%, that is a great, great return. I mean, I don't really see why we would want to chase stocks that are up 30-40% here, like, mega cap, tech, when, the Treasury is paying you 5.25% not to take any risk. I wouldn't chase that at this point, especially at nosebleed valuations. So, parking your money in a money market fund that invests in only treasuries and direct deposits with the Fed are, recommended. Focus on earning certain companies with low beta, with dividend growth and or share buybacks, and a low PE multiple or a low price to free cash flow multiple relative to the 15-year median. So position for a low growth environment with a combination of recession resistant growth, which is our earning certain proxy, and income, which is 1-year treasuries. So these are the types of companies we own in our earning certain proxy. Clorox, Global Payments, these are great companies to be owning at this point right now because of how cheap they are and how recession resistant they are. And here you can see exactly how recession resistant they are. Great companies for long-term holds here. So again, thank you again for bearing with me. I know I've been kind of beating a dead horse here over the past 10 months now, but I continue to believe that the equity market remains vulnerable, and I still continue to believe that we should all remain defensively positioned here with recession-resistant companies and short-term treasuries, money market funds, and sort of 1-year treasuries. So I hope you found this helpful. If you have any questions, please do reach out to me. If you are a ZRS client, you can send us an email at zrs@zacks.com. And if you are an Advisor Tools client, send us an email to zat@zacks.com. All right, thanks everyone, and I will be sure to provide you an update in the near future again. Take care, everyone.